G'day everyone, welcome to this weekend general update. And everyone around the world is basically on hold while these very silly and selfish US politicians continue their wrangle in Washington. All the indications are that this debt ceiling debate, this impasse that they've got, is going to be resolved. But who knows how long they'll string it out. I mean, it has to be resolved because the consequences of them not resolving it are just too horrendous to even think about. So I'm sure no one will go there. In the end, it's a bit of a game of chicken at the moment. Someone has to blink, and I suspect that they'll continue it for a little while yet. So we remain on hold while this silliness goes on, but the markets are actually taking it very much in their stride. As you'll see from the charts, there's really no indication of any fear or upset at all. And yeah, we'll just have to wait and see what the next couple of weeks holds. But look, it does not change the overall scene that I've been painting now for most of this year. It doesn't change it one little bit. This is still an outstanding investing period, and it's really just a matter of sticking to the process. So let's start off by having a look at our members' recommendations trading results for the current calendar year to date. This is something that I do on the first weekend of each month. And so the current result is $7,511 gain. They are closing prices as of Friday, the 4th of October. That, of course, is based on a trading float of $20,000, risking $300 per trade. We've taken 48 trades, which was just a couple more than where it stood at the start of September. The win rate is steady at 76, so that's a very pleasing win rate. And the size of the winners to the size of the losers has dropped slightly. It's down to 1.68 to 1, but nevertheless, they're outstanding results. 3 out of 4 trades are successful, and they're nearly 1.7 times as big as the losers. Now, the overall profit has declined a bit. It's down about $500 or so from September, and that's largely because of one trade. It was a trade that we were something like 70% in front on, so that had been the best performer. And in the last couple of weeks, the price of that stock has pulled back. We're still comfortably in front, and all the signs are that it's probably bottomed and will head back up again from here, because the fundamentals really are incredibly attractive down at this level. So there's been a little bit of a retraction in the overall profit to date, but as I said, it's associated with one stock, and the rest of it has been trundling along quite well. And it's fairly typical of the way that trading results go. You tend to get the best results coming out of corrections, and then a couple of months after the correction, your trading results quite often plateau for a little while until you get another spurt in the market, and that's just the period that we happen to be in at the moment. But my overall view is that from here through till probably at least April next year looks to be a pretty robust period to be trading and investing and making money. So let's have a look at a weekly summary. The S&P index ended up losing 1 point on the week. So it did decline a bit, but it also bounced back fairly strongly on a couple of occasions, including Friday night. So just the 1 point lost on the week. There's a little bit of mild nervousness, but really it's not amounting to very much at all. And all the indicators that I'll show you in a minute remain remarkably calm considering what's going on. Markets will quickly return to normal once the politicians reach some form of agreement, and I think we'll then see some good returns. Now, this doesn't change there is a looming crisis of confidence coming. Now, I believe that's at least 2 years away, could be 5 years away, could be 10 years away. but I believe it's at least 2 for the reasons that I've been outlining over the last few weeks. So that gives us a pretty healthy window of opportunity to pursue the profit potential. And of course, the other side of that coin is that if you don't get on with it now, then in a couple of years' time, the conditions are going to be nowhere near as good as they are now for making profits. So we've got a window. It's the best window you're ever going to see, so get stuck right into it. Now, just a little bit more on the self-interest theme that I've been talking about over the last month or two. Just looking at this situation from the self-interest of the US government, because in the end of the day, self-interest is what is going to underpin markets and drive markets. Now, the US government is looking at 2 alternatives at this point in time. One of them is inflation and the other one is default, which means they then lose their reserve currency status. There's no way known they're going to default until they reach the point where they're absolutely forced to. And as I said, that could be 2, 3, 5, 10 years from now. So they will choose inflation. And that's why the monetary policy of the US Fed is not going to change. And I don't believe there's going to be any tapering of their bond buying program. I believe they're actually going to increase it. Now let's look at the self-interest of the Fed. A rise in interest rates, and we saw that just in anticipation of them starting to back off their bond buying. The interest rates rose by about 20 to 25%. So a rise in interest rates makes them quickly insolvent. So the Federal Reserve would actually become insolvent because they own a lot of bonds. All the bonds they're buying from the US Treasury or the US government to allow the US government to run these deficits, then the value of those bonds on their balance sheet would fall. And the dimension of that fall would more than wipe out their assets because their current exposure to those bonds is many orders of magnitude more than their actual cash assets. So the Fed can't allow interest rates to rise. And yet any reduction in the bond buying program is going to see interest rates rise. So I just can't understand why there isn't more focus on this at the moment. The fact that there's no way known the Fed is going to be able to accommodate rising rates because, as I said, they'll become insolvent. So the only ability they will have is to print more money. That's all they can do. They don't have any shots left in the locker. And that's why this is such a good period for stocks, because you've basically got the Federal Reserve of America underpinning stock markets for the foreseeable future. Now, I'll just have a look at the ASX 200, then we'll go and have a look at some charts. So the ASX 200 ended up declining 90 points on the week, but it will rebound on Monday. I would expect that it'll pull back a good slice of that 90 points. So that's just a bit of a timing issue. It was mainly the large resource stocks that were down a bit during the week. The banks were pretty steady. Small caps remained resilient, so they're looking pretty good. The good stocks are simply consolidating before the next run. Pure and simple, there's not much downside in those really good stocks. And there is a technical pattern which is providing highly profitable trades. They really are amazingly profitable trades. So it's all steam ahead at this stage. So let's have a look at some charts. So we'll start first of all with the S&P index. Now the thing that I want to point out here, and there are some commentators in the marketplace who are calling for very substantial correction in the market, one of whom has actually advised their clients to go to 100% cash. Now I just don't know where that view is coming from, because let's have a look at this particular price chart. Now the red line here is the 150-day moving average, and you can see that it's still going up at a very robust rate, and there doesn't appear to be any sign that that rate is declining. The second thing to look at is the price of the index has remained above that moving average throughout, and the peaks above the moving average, so the deviation, so let's have a look from here, well, let's do it this way, from here to here remains about the same, from here to here about the same, and here. So the index is still increasing or getting ahead of the moving average by about the same amount. There might be a very slight reduction. The second point to note is that the pullbacks from the peaks are not getting any closer to the moving average. So this one here didn't even make it back to the moving average, which is an indication of strength. The next one was even less decline and didn't get any closer to the moving average. And the same here, where we've got the American government now in shutdown, and there's hardly been any really meaningful pullback at all. So just looking at the S&P chart alone, it's pretty hard to see that there is any pattern there that suggests an imminent danger. So if we just look at this last week or two since this debt ceiling crisis really accelerated, you can see it's just been up and down, and largely for the last 5 or 6 sessions it hasn't really done much at all. It certainly hasn't declined savagely as many people were predicting. So there are a lot of positive signs on the S&P. Let's have a look at the Russell 2000. Now, whenever we're going into significant corrections, the small cap stocks get sold off heavily. The breadth of the market contracts, and you get the main market indices like the Dow and the S&P being held up by the large stocks. This is not happening. You can see, in fact, that the small cap Russell 2000 is actually outperforming the larger stock indices. So pretty hard to see an indication from there. Let's have a look at the VIX index. This is the VIX index, the fear index that spikes up when people are really uncertain about what's going on in the market. You can see over the last few months, and in particular the last week or two, there's hardly been any movement there in the VIX index at all. So it's really hard to see anything that is untoward in current markets. So I remain pretty comfortable with the way things are on a big picture level. Now, short term, these US politicians can do dumb things, so you just be mindful of that fact at this point in time. Let's have a look at the Australian index. Not really much downside there. Most of it occurred on Monday, and I would expect we'll see a rebound on Monday of the coming week. So it's still looking in pretty good shape at this stage. Now, gold fell by $30 on the week, and we'll have a look at the gold chart because it's in a bit of a declining channel over the short term, and it needs to break above 1340 to break out of that channel, and then to really confirm that it's in uptrend, it needs to close above 1440. So they're the two key levels for gold. It's really an absolute mystery to me why gold is not as more robust, given the current uncertainty and circumstances, and the fact that the Fed is now, printing money like there's no tomorrow, with no sign of that being reduced. These are perfect conditions for gold to be going up. So I'm completely mystified why that's not occurring. Now, copper was steady on the week at 329, and oil was also steady at $104 a barrel. So no real change in commodities there. This is the spot copper chart. So you can see it hasn't really changed much, been between 320 and 330 now since early August. So let's have a look at the gold charts. So you can see this declining channel. Now, it looks like we've formed a base. We formed higher highs and higher lows through the period from July up until late August. We've now retraced part of that, and you can see there is a declining channel there. So we need to be above 1340 to get out of that channel, and then we need to be above 1440 to break to a new medium-term high. Now let's just have a look at where we are in terms of the retracement structure. So at the moment, 1282 was the bottom of the retracement structure. We hit a low of 1278 on Wednesday. So hopefully, if it goes below 1278, in the next week, then this declining channel is still in force and we could be heading back down to retest 1180. I hope that's not the case. It shouldn't be the case based on fundamentals, but this is a heavily manipulated market, so you've got to remember that. But at the moment, that's a possibility that we've seen the bottom, but we do need to see a close above 1340 and then ultimately 1440. Now, as a consequence, the gold stocks haven't done very much. You can see they've just declined very slightly over the last couple of weeks. So in actual fact, the gold stocks are slightly outperforming the price of gold. They're not going down quite as quickly as the gold price is. So that's the situation with gold. Let's just have a quick look at silver. Silver is actually doing slightly better. You can see it's not in a declining channel. It actually is forming a bit of a base there now. So hopefully that's a bit of a sign of a turn there for silver. So just to finish off, just from an overall strategy point of view, just given the fact that US politicians could come up with something really weird and stupid, I'd be looking to hold a bit of cash in your trading account, just so that if we get any short-term opportunities, you've got a bit of cash to take care of it. And as I mentioned earlier, there are patterns that are proving to be extremely high probability. It's a combination of both fundamental criteria and technical criteria, and they're quite stringent criteria, but they're generating almost 100% success rate this calendar year. It's a fabulous pattern. So if anyone who's not a member wants to know more about that, then please get in touch with me. That's my email address, and be happy to converse with you. That's it for this week. Cheers.